If there was a company who continued to produce double-digit profitable growth and has the potential to continue on this trajectory for at least 5 years, plus has twice the annual revenue than their entire market cap, would you call that undervalued? Well, CarParts.com has done just that. So in this video, I want to share my thoughts on their earnings report and conference call, as well as talk about what I'm doing with this company. But I don't want to waste your time, so let's go ahead and dive right in. So CarParts.com is a company who sells auto parts for car repair, maintenance, collision, and accessories for competitive prices online. When we look at this industry, they do have some solid competitors like Autozone and O'Reilly, but there's still plenty of space in the auto parts sector for all these companies to thrive. The total addressable market, or TAM, for CarParts.com is about $300 billion, and they are under 1% of that amount. But when we look at these companies, there is a significant difference between them and their competitors. And it all comes down to the simple fact of selling all their products and services online. What we learned from Amazon is that companies don't need physical locations to sell product. However, in the auto repair industry, this is even more important because in some cases, if something goes wrong with a vehicle to where it could be difficult or dangerous to drive, you probably won't want to actually drive to the location to get the part that you need. So this business model, in my opinion, is a good one, and they are proving that it is successful by taking market share from their competitors. Given the shifts in the macroeconomy and recessionary environment, there is going to be a change in consumer spending even going into 2023. But the reality is that no matter the current financial situation, cars will continue to need repairs, and I think this protects them from anything that could happen to the economy. And this is especially true now when we are seeing people move to older vehicles because of the surge in used car prices and the increase of interest rates. So not only does this positively affect car parts now, but it will also be important in a couple of years as these used car purchases are going to start needing repairs. And even though there were stimulus checks to get auto repairs last year, we are still seeing double-digit growth this year. And I think this all comes down to the management team's game plan and execution. First, not having physical locations allows the company to have lower expenses because they don't have facilities to keep up and they don't need to pay for workers in those facilities. Second, their strategy allows them to send parts directly to consumers, and this could apply for auto repair shops or individuals working on their own vehicles. Third, their warehouses are in prime locations, so they will be able to send their parts in a couple of days. But before we dive into the earnings report, let's talk about the price action. Car parts hit an all-time low of $3.92 back on November 9th. But once those earnings came out, the stock spiked massively, and they are now trading somewhere around $5.50. But to put things into perspective, this is still significantly off their all-time highs. In June of last year, this company was $20 a share. And right now, as of recording this video, Car Parts has a market cap of about $300 million. But let's go ahead and talk about the numbers from this company in Q3. When we look at their revenues, they generated about $165 million, which is a 16% year-over-year revenue growth. Analysts expected them to do just under $169 million. So this is a slight miss. Now, as a growth company, some people may say that 16% is not great, but when we consider the different sectors, some are moving faster than others. If we look at a company like O'Reilly, for example, they grew only 9% year over year, and AutoZone also grew about 9%. So this is why it is important to look at the competitors in the industry and not simply what other sectors have for growth rates. The growth that Car Parts is producing exceeds their competitors, which means they are picking up greater market share. Plus, when we look at the current revenues and their total addressable market, which is starting to grow even more, they have put themselves in a great position to expand for probably the next decade. Now, here are some things to keep in mind when it comes to their growth. Not only have they had 11 consecutive quarters of double-digit growth, but over the past 2 years, they have had 37% revenue growth. And when you consider the fact that people had so much stimulus this time last year to where they can do all these repairs and upgrades, to have double-digit growth the following year is impressive in my opinion. Now let's look at a metric that I'm always paying close attention to for any company, and that is adjusted EBITDA. They had positive adjusted EBITDA reaching $6.3 million in comparison to $2.3 million last year. Now this goes to show that their current business can continue to be profitable, and as they grow revenues, adjusted EBITDA will continue to grow with it. But not only did they have positive adjusted EBITDA, they also beat analyst estimates for net income, losing only $0.9 million. This gives them an EPS loss of of 2 cents a share in comparison to the expected loss of 4 cents per share. At the beginning of the year, I said that funds are looking for profitable companies or companies that are going to be profitable, and I think that this is only a matter of time before car parts really gets on many investors' radars. Looking at gross profits, they grew 19% to $56.1 million, once again proving that their business can flourish no matter the environment. And this is also shown in their gross margins as they increased this metric by 70 basis points to 34.1%. Honestly, how many companies do you know are increasing gross profits and margins in this environment? There aren't many companies, and actually several of them have significantly lower margins. This growth came while navigating freight costs, and they really optimized their data analytics to determine what are the best prices to sell for their products. Now let's look at the balance sheet. The company did slightly increase their cash position to over $16 million in comparison to $15 million last quarter. The company also has over $9 million in accounts receivable as well. Now, one thing that is important to see is the amount that they have in inventory. Car Parts has over $150 million in inventory. Now, this seems like a lot, but when we have so much uncertainty with the supply chain issues, it made sense for them to have a high amount of inventory. And what this allows them to do is have the inventory so that they won't have parts out of stock, unlike their competitors. And this is another benefit of using warehouses instead of retail stores. But as the supply chain pressures ease, the company will be able to reduce the excess inventory, and that will move to cash over time. Ryan Lockwood, the CFO, made it very clear that they believe the company has ample liquidity and that there is no intention or need to raise capital at current valuations. And a major reason I believe they feel this way is because they have $59 million available on a revolving credit facility with an option to expand to $150 million depending on inventory levels. The next thing that I want to focus on is their recent launch in Q2 of their Do It For Me initiative. This is where customers in certain markets can see the installation price and book an appointment for a certified repair shop in their area. Now, I think that this is the cherry on top and could be a game changer if the company is able to execute on this business segment. They have recently passed 1,500 bookings from their Do It For Me initiative, but there was one line that I believe the management team said that shows why this solution could have huge potential. From a pricing standpoint, in some cases, shopping on our website may offer customers an opportunity to pay less for parts and labor than they would for just the parts at a brick and mortar or a dealership. And with the fact that consumers are trying to be mindful of their spending, this could bring the company not just more revenue, but more customers to do business with. Think about it this way. For many people, they rely on others to help them complete their repairs or maintenance work. So if more customers enjoy this product, this part of their business could be growing simply through the word of mouth. Now, granted, this is only live in certain test markets, but from what we have seen, this could be a successful solution moving forward. This enables them to basically be a one-stop shop to order parts, but also have a local mechanic already available for the repairs. And for car parts, they don't need to pay for the mechanics, so that means less expenses. Plus, they get to grow their brand awareness with the shops that they are working with. But I also have to mention that this business has not contributed to the top line yet, and more than likely won't for 2023. However, what this means is that their normal business is what is generating the double-digit growth, and that is solid given this current economy. And rather than just doing a grand opening for this side of the business, they want to take their time and really focus on the customer experience and reviews before they launch it elsewhere. I think this is extremely important for the following reasons. First, the customer experience and reviews are always one of the top priorities for a business, because not only does it help retain customers, but it also attracts new ones. I mean, can you imagine if iPhones received a 3 out of 5 stars or worse? What about Tesla vehicles or apps on the App Store? Reviews play a huge role for any kind of customer, whether they are returning or not. Secondly, as Car Parts continues to show how strong this segment could be, their marketing will be based more on evidence rather than trying to persuade someone how good the product is. If the business works well and they have solid reviews, then that will bring in more customers. And as I said previously, I think word of mouth could be a huge piece of this business. I mean, how often do you hear people talking about getting their cars repaired? If the business model works as well as they've been saying, then this could draw a whole bunch of people, because when it comes to car repairs, it is extremely stressful, and this product cuts right through that. So personally, I would prefer them building a strong base of good reviews to attract more customers in the long run than do a massive marketing campaign to get a whole bunch of customers in the short term. And as long as Car Parts continues to execute on this business solution, this adds a whole new sector to their total addressable market that isn't cost intensive. So I am going to pay close attention to the development of this business over the next few quarters. And speaking of the next quarters, they are continuing to focus on balancing growth with profitability. And we can see that in Q3's adjusted EBITDA. I cannot say enough how important this is for a company during a recession, and even if analysts don't see this company right now, their track record is going to prove that no matter the environment, they are going to be able to thrive, and this makes Car Parts not only an attractive company when things are going well, but it is also a safe stock, especially given their needs-based products. Now, in Q4, we did not get much in terms of guidance. However, the company does admit that the fourth quarter tends to be lighter in terms of profitability and revenue growth. Now, that doesn't mean that they will see declines in their revenues or net income, but I think it's fair to not expect growth from Q3 going into Q4. The reason why is because people defer their spending to do Christmas purchases and travel. Now, analysts for this upcoming quarter are honestly believing that this is not going to be good for CarParts.com. They expect to see an EPS loss of 11 cents compared to 9 cents last year. Plus, they expect revenues to grow less than double digits. Personally, I don't think that this is a good idea to bet against this company, but we will see what happens. In terms of what I'm doing, I'm continuing to add under $8, and when it is below $6, then I am even more aggressive. There are simply too many things that are working well with this company, like their profitable growth, market share expansion, and a game-changing innovative product. And this makes it difficult for me to not keep buying. Hope you all enjoy this video, and I'll see you in the next one.